Hello and welcome. I'm Angie, and today we're diving into Chancellor Rachel Reeves' highly anticipated Mansion House speech, scheduled for Tuesday, July the 15th. With the cost of living crunch, ISA reform chatter, mortgage help on the way, and the pensions review set to launch, this address could reshape UK financial policy. And I'll be back after the speech on Tuesday with a full breakdown. So let's unpack the pre-speech buzz and what to expect. The Mansion House speech on Tuesday is the Chancellor's annual speech to the City of London's leaders at Mansion House, the big financial moment of the year. It's traditionally used to signal regulatory reforms and set out the government's vision for finance-led growth. Reeves took this stage for the first time in November of last year, 2024. Now it's her second outing, keeping an eye on or monitoring the warnings or important advisories issued by City AM about financial matters, markets or policies. And the bank expects real action, not just rhetoric. Money Week and other key financial reports and Martin Lewis say Reeves will propose slashing the £20,000 annual cash ISA limit, possibly to as low as £4,000 to £5,000, aiming to shift savers into equities. Supporters say it could steer the £300 billion hoarded in cash ISAs into UK-listed stocks. But Building Societies Association warns that cutting the limit could reduce mortgage funding and drive mortgage costs up. Polling by AJ Bell, the well-known UK investment platform and financial services company, which focuses on pensions, investments and retirement planning, has conducted a survey. And it suggests many savers would more likely switch to regular savings, not investing it, which is hardly the intended outcome. Money Saving Experts founder weighed in this week, saying such ISA cuts would be a mistake. Did you know that more than 50 building societies and other financial firms have signed an open letter urging the Chancellor Rachel Reeves to save cash ISAs by keeping their £20,000 tax-free limit? And, as Martin Lewis warned, simply slicing ISA allowances risks punishing savers who are risk-adverse and could easily backfire. You see, his point is that the policy may not push savers to invest, it could just reduce their returns. Meanwhile, leading city and investment firms and UK bodies are calling for bold steps. They want to scrap the 0.5% stamp duty on shares, claiming it's the better lever to boost equity investment. Platforms like Hargreaves, AJ Bell, IG, Interactive Investor say cutting ISA limits alone won't significantly grow investing. They say that if the government removed the duty, it could boost the London Stock Exchange by encouraging savers to invest and help Rachel Reeves achieve her aims of growing the UK economy. They also talk of targeted financial advice reforms from the FCA, which is the Financial Conduct Authority. That's the UK's financial regulatory body responsible for regulating financial firms and markets to ensure they operate fairly and transparently. Their aim is to help savers move from cash into investments more effectively. One of the main expected announcements is a pension adequacy review. Now they're appointing a commission to tackle retirement shortfalls. This is actually phase 2 of the pensions review, focusing on auto-enrolment, state pensions and self-employed retirement savings. Now, a pension adequacy review is an in-depth examination of whether current pension systems, such as workplace pensions, the state pension, and provisions for the self-employed, are sufficient to provide individuals with a comfortable standard of living in retirement. The UK government is set to launch such a review, appointing an independent commission to assess and recommend improvements to the existing pension framework. Watch out for this. So what does a pension adequacy review involve? Well, they are set up to evaluate current pension systems, and their review will assess whether the current pension arrangements, including auto-enrolment and the state pension, are adequate for most workers. This includes examining contribution rates, investment strategies, and the adequacy of retirement income provided by these systems. Number 2, they will identify shortfalls, that is, identify groups at risk of inadequate retirement income, such as low earners, part-time workers, and the self-employed. Studies indicate that a significant portion of the population is not saving enough for retirement, with many falling short of the minimum retirement living standard. So number 3, the pension adequacy review will set adequacy benchmarks. It aims to establish clear benchmarks for what constitutes an adequate retirement income. Number 4, based on its findings, the Commission will recommend policy changes to improve pension outcomes. This may include increasing contribution rates, adjusting the state pension, and implementing measures to support the self-employed. But the snag is their implementation timetable, because the Commission is not expected to report its recommendations until late 2026. Any legislative changes arising from the reviews are unlikely to be implemented, therefore, before 2027, with a phased approach anticipated as well. But this review is vital because, with millions of individuals at risk of facing financial difficulties in retirement, addressing pension adequacy is crucial. The upcoming review represents a significant opportunity to reform the pension system to ensure that all individuals can achieve a secure and comfortable retirement. And yes, there's talk of megafunds, consolidation of local government pensions to back bigger asset investment. And why is this a good thing? Well, megafunds will provide bigger investment power. It will lower costs and provide better efficiency. It will improve returns and stability and offer risk diversification, spreading risks across many asset types and sectors, thereby reducing the chance that any single investment badly impacts the overall fund. So how does this relate to pension adequacy? Well, by pooling resources into megafunds, local government pension schemes, for example, might generate stronger returns and reduce costs, helping to close funding gaps and improve the financial security of retirees. This is a key strategy within the wider pension adequacy review aimed at tackling retirement shortfalls. Now let's look at the new mortgage guarantee scheme. Reports indicate Reeves will confirm a permanent freedom to buy mortgage guarantee offering 95% LTV for first-time buyers and movers, so that mortgages offered through the scheme will mean first-time buyers and home movers can buy a home with a deposit of just 5%. The government sets a £3.2 billion cap. Lenders pay fees, hoping to restore confidence post-downturn. But critics caution that the scheme helps with deposits but leaves several barriers: finding the deposit, repayment worry, and supply is still limited. You see, the problem with this scheme is it solves one, but it exacerbates the other, because buying with a 5% deposit will still leave you with a 95% mortgage to service. Increasing supply is the only way to make home ownership more affordable in the long term, and we've yet to see any dramatic increase in housing starts. So, to sum up these main pre-Mansion House speeches, which is coming on the 15th of July, number 1, we are likely to see ISA cuts. It's fuel for debate over savers versus investment push. Number 2, there's a stamp duty repeal on the horizon, demanded by financial industry. 3, a pensions review and megafunds for long-term retirement focus. 4, a mortgage guarantee scheme, perhaps, tackling housing affordability but not offering a complete solution. And 5, we'll see perhaps financial advice reforms with targeted nudges to invest, but lots of ifs and buts here. So Reeves' Mansion House speech on the 15th of July promises major moves on pensions, mortgages, ISAs, financial advice and equity incentives. But the devil's in the detail, and the responses will define her agenda. But I'll be returning after the speech to bring you a full breakdown of what was said, what was watered down, and what's next. See you then. And don't forget to like and subscribe and share to be sure to see this next video hot off the press. Bye for now and enjoy the lovely weather today.